the inflow of these stablecoin is an indicator that buyers are coming in. Because most retail users don't actually buy or mint USDT. Bonnie, have you minted USDT before?
Nope.
How do you make sure you quickly buy, but you can also quickly redeem when people want their money back? When you're holding a stablecoin, you are holding claim to someone, right? So when you hold USDT, you have a $1 claim to Tether. When you hold CRVUSD, you have a $1 claim to the CRVUSD smart contract. You have to trust that the issuer of that stablecoin is going to give you your money back, because you have to believe that the person who you're going to give that stablecoin to also believes that.
You talked about the inflation in Argentina. Can you just help me visualize how bad it is?
You lose context of what things are worth. Let's say you take a 2-month trip somewhere, you come back, and you have to think about the prices in the supermarket in US dollars. How many layers of risk are you taking when you're buying some of these decentralized stablecoins? Probably tens of layers. You need one to go wrong, the sophisticated actor is going to get out very quickly, and then you're going to be holding the bag.
The value of ETH comes from its utility as, if you like, digital oil, like the powers the Ethereum blockchain. So as the transactions move to layer 2, I do wonder what the price will be of Ether as a gas, in layer 1. So that might affect long-term projections of the value.
Got the whole crypto world going wild. Money blockchain, she's the queen of the game. Stacking crypto like it's her claim to fame. If you want success, then take a look away.
Okay, hello guys. We have Alvin from DeGate,
Hello.
Martin from Mountain Protocol,
Hey, good morning.
and we have Chris from Mr. Block.
Yay.
Howdy, hello, ni hao.
Okay, we're going to talk about stablecoins today, and I feel like recently we see like a surge in stablecoin, and the total stablecoin market cap is at 150 billion right now. What does the inflow and outflow of these stablecoins tell you about the market?
I've been in the crypto since 2011. That's when I first bought Bitcoin. And then, back in the days, there wasn't Tether. There weren't USDC. It's old fiat, right? People buy Bitcoin with Taiwan dollar. People buy crypto with RMB, with USD. When I first saw Tether, it was around 2013, 2014, 2015. It was on the Omni layer, the Omni chain. The total TVL was like a million, I think, when I first saw it. There was no one using it, right? And then obviously, it really became huge in 2017 when Chinese government decided to ban crypto exchange, and people have to find a way to kind of go through these loopholes. That's where the stablecoin came out. I want to give this little background because ever since then, it became a way to track these inflow and outflow. Because before that, it was impossible because we wouldn't know how much money these exchange kept in the bank account, right? We wouldn't know if they're $1 billion or $10 billion. There was no transparency report. That idea didn't even exist. USDT became one of the main stablecoin on Binance, and Binance became one of the largest crypto exchange, surpassing Kraken, Coinbase, and everyone else. From then, it became obvious the inflow of these stablecoin is an indicator that buyers are coming in. Because most retail users don't actually buy or mint USDT. Bonnie, have you minted USDT before?
Nope.
No, right? So most of us, we're retail. Well, if they want to put in 10 mil or 100 mil or a billion, dare I say, they'll go through these stablecoin company. From then, it became an indicator. So coming back to your question, I think it's still a really strong indicator. After 2017, USDT, USDC died. Multiple type of stablecoin design, multi-collateral design, single collateral design, the maker DAO liquidity design, algo stablecoin design. There's multiple ways to design these stablecoin, but all in all, still come down to USDT. That became one of the main indicators to know that, okay, the market is getting hot again. So I think it's still a strong indicator.
I very much agree with that. I would say the way I look at it is stablecoins kind of thinking about the use cases, right? So the first use case, as Chris said, is trading and trading settlement. So you would see USDT being used to settle between exchanges, kind of like move out of BTC settlement into stablecoin settlement. I think USDT has grown through the last bear market substantially. And at least in my mental model, that is a different use cases, which is emerging economies trading accounts. A ton of people that hold 1,000 USDT, 10,000 USDT, or companies that hold 10 million USDT as a way of holding the equivalent of a US dollar bank account. And that is a use case that I think is taking over USDT and is explaining a lot of the growth of USDT, and especially during the bear market. And then you have the use case of kind of DeFi, I think mostly owned by USDC, right, on L2s and so on. The last piece that I'm seeing recently on the stablecoin development is kind of like a move out of stablecoins back again, right? So you see large institutions that are trading in exchanges, and as opposed to keeping stablecoins in the exchange as a way to trade, they're doing a three-party arrangement using a bank account with T-bills, so they can capture the 5% yield while trading in that exchange. A lot of the compression in stablecoin volumes has been due to that. Now the market is heating up, there's lots of inflows, but there are those outflows. So going back to Chris's tracking what's happening, I think we're starting to lose track again, given these three-party arrangements, especially for large traders in many of these exchanges. And a little bit of what we hope to do is to get that in this market so we can continue to keep track a return on your stablecoins and actually use the stablecoins as they're meant to be. So all in all, I would say market is heating up, stablecoins coming in, retail using stablecoins for other use cases other than trading, mostly savings account, but also you see an outflow on these three-party arrangements, which are quite substantial, right? Hundreds of millions of dollars or billions of dollars in some cases.
So how do stablecoin issuers make money?
Yeah, so I can go to that question. If you look at USDT, they've been public about how much money they make. They make a lot more money than Ethereum gas fees. Like I think 2x the money that every user spends on Ethereum gas fees. From a fintech perspective, it's one of the best fintechs ever built in the history, right? Probably compared to PayPal or Stripe or something like that. The way they make money is if you give them $1, they put that dollar to work. Hopefully, it would be at 5%. We don't know exactly what the Tether is composed of. They say they're investing into a biotech company. That money is getting invested, and you, as the holder of USDT, of USDC, you're earning 0% from that value. The equivalent to a USDT or USDC would be like holding stake ETH, but Lido charging 100% of the yield. So they pass you 0. When you look about it that way, it's kind of insane, but that's the amount of money they make. And each staking is currently paying kind of 3%. Short-term treasuries are paying 5%. So it's almost double the revenue as Ethereum staking, and they get to keep 100%. That is billions of dollars every year that the whole crypto ecosystem that is getting kind of extracted out of the crypto ecosystem for these issuers, and essentially generating a lot of drag in the ecosystem.
Okay, Chris, do you have anything to add?
I think stablecoin issuer has a really strong edge here, and it's rightfully theirs. It has all these use cases and everywhere in crypto. Obviously, talking about USDT, they don't really have to give any of those yields to USDT holder. Tether is one of the biggest T-bill buyer. They don't really share any of those yields to USDT holder, and USDT holder would actually have to pay minting fee and redemption fee, right? So essentially, they have, like Martin said, one of the best fintech design ever, and all they really have to do is make sure that one is, they don't get taken down. And I think that's one of the main reasons they're buying so much T-bill, right? On the other end is, trying to get USDT accepted everywhere, right? So everyone is on this boat. If it gets taken down, then you're at war with, hundreds of millions of people that hold USDT. All its competitors are trying really hard, more transparent, both audits and legal side of stuff. So I think there's always going to be, pros and cons when it comes to stablecoin. I think, Tether has a very unique position, but that doesn't mean that other stablecoin protocol will not have its time. We like to see, more and more choices for these stablecoin protocols and then stablecoin company. And, I like to say that there are different types of stablecoin out there. And, on Curve, there's CRVUSD, LUSD, and their use cases are very, very different. When it comes to creating a stablecoin, it's not only about these pure yields. It's also about how do you find these target audience and create a product that's catered to them and keep growing. A good example is Athena, right? Athena recently created very interesting use cases that previously people weren't really looking at it. So USDE, it now has around, I think, 1.3 billion, shows that people that are able to take high risks, and these people are similar to Luna, right? Luna UST user. I'm not saying Athena's kind of like Luna, but I'm saying that it also has this high yields to attract people. And that's like opposite from Tether, where Tether don't give you any yields and charge a lot of money, but because everywhere can use it, so people use Tether. But then on the other spectrum, you have a protocol that want to track these 1% of users that want high yields.
USDT, last time I checked, it has 70% of the market cap. If there are other stablecoin issuers that gives more attractive yields, why is USDT still dominating?
It's like Visa and MasterCard. If you try to create a new credit card network, it is very, very hard because each customer you go talk to, they want their merchant to accept it. So they want to use that plastic and get it accepted. And each merchant you talk to wants consumers that can actually pay with the card. So in the end, you're kind of in a chicken and an egg problem where the network effect of acceptability or people accepting USDT as an equivalent of $1 is very, very deep for USDT. Even USDC has not been able to break that at the point where USDT is, right? Like I'm from Argentina. When I go there and try to buy Argentinian pesos with crypto, the people who exchange will only take USDT on chart. That's the only thing that they accept in crypto. So that is the biggest reason is acceptability. People, education of this mass market is not that easy. And the acceptability that USDT gets gives it a very strong guarantee around the $1 because there's always someone willing to take the USDT around $1. So the purpose of the asset being more transactional and the acceptability that asset has gives it a very strong moat when we are trying to get in, or team is trying to get in, or whoever's trying to get into that space.
It's astounding to me that the traditional stablecoins like USDT and USDC, we don't see, they take so much of the yield. When we saw Mountain Protocol, there's a great revelation that you could have a unit of account that's tied to the US dollar, but also generating yield as it sits there in this case, DeGate's DEX. So my suspicion is that the era of USDT dominance is not going away anytime soon, but it's slowly being eroded by all these new models eventually.
We are going to talk about all the different types of stablecoins because when I talk to people like my uncle or my auntie, a lot of people outside crypto, they do not understand the concept of stablecoin. They think these issuers are printing money out of thin air. We do have a lot of different types of stablecoins, and can you give us examples of the specific type of stablecoin and explain to us the process of making each type of stablecoin? What has to happen before you create, for example, one USDT or one USDM? Let's start with Martin. Do you want to talk about fiat stablecoin?
Yeah, I would say fiat-backed stablecoins are stablecoins backed with cash equivalents. When you give us $1, give USDT or USDC $1, what happens is we will turn around, give that $1 to a custodian, and they will buy $1 worth of very short-term US treasuries or a repo or something, which in accounting is called cash equivalents. That way, that money is essentially lent out to the US government. The US government will pay you 5% interest for doing that transaction, and that is held as collateral. The quality or the legal claim in that collateral is a big question, right? Like how safe is that from the issuer going down? And I think there's a different palette of colors in how safe that is, but everyone essentially has reserves held in T-bills. And then on the other side, there's a minting of that new USDT, USDM that is given to the primary buyer, in this case, usually institutional buyers. So for $1 that comes in, it turns into a T-bill, and that turns into an ERC20 that gets out. So essentially, it's a T-bill on the back and an ERC20 in the front. That is the definition of a fiat-backed stablecoin. And the challenge of running these models is how do you make sure you quickly buy, but you can also quickly redeem when people want their money back. And it's all about building a very strong financial piping into that operation.
Chris, do you want to talk about crypto-backed stablecoins?
We talk a lot about the fiat ones and then how, it generates from T-bill. Crypto is in a very different way where mostly it's over collateralized. And it all started with single collateral designed by MakerDAO where it used ETH as collateral. And, before we moved from proof of work to proof of stake, holding ETH has zero yields. Back then, there wasn't this concept or it wasn't possible to have collateral to earn yields. Not like how Tether can mint USDT or USDM for Mountain to earn from T-bill. But now with LRT protocol and LSD, it is now possible for multi-collateral backed or single collateral backed LSD stablecoin that generates 4 to 5% yield similar to T-bill in an ETH format. So a good example of this protocol is Prisma, which use these LRT protocol. So essentially on top of the 4 or 5% yields that generated from using your ETH as collateral, you will also earn the underlying protocols such as EigenLayer and Puffer Finance or EtherFi. So that's the beauty about these crypto-backed stablecoin is that it gives you access to DeFi. When you come into DeFi, there is smart contract risks, all type of counterparty risk, and you can lose your private key, for example. In return, you have high yields from these protocol. In the current market, there's 3 main stablecoin protocol, and that is the MakerDAO design, which you will need liquidator to comes in and liquidate. Well, all of them has it, but MakerDAO specifically, you need liquidator to come in. If ETH price go down, then use the stability pool to go and buy these trove that has a lower collateral ratio. And then there is Curve and the Aave model. The Curve design is kind of learning from the previous 2 design and have what we call soft liquidation. So that instead of having this really harsh liquidation when it comes to these black swan events, we have this more of a soft lending design. But when we talk about crypto-backed stablecoin, right? Crypto-backed, everything's on chain. So you could have liquidator that will just jump in and try to profit from these positions. In Curve design, if your collateral price goes down, you don't instantly get liquidated because the price might jump back up. Doesn't get fully liquidated, you still have a chance to kind of slowly get pegged back. So the idea is that let's say you have $1 million worth of ETH as collateral and the protocol mints, let's say 100K. That means you're 1,000% collateral ratio. And let's say all of a sudden, ETH for some reason went down to like, I don't know, $100 or something. And then theoretically, the whole position could be liquidated. But having a soft liquidation, essentially, you give time to pack back. And most of the time, attacker, they use this thing called flash loan. So the whole thing have to happen in one block. Anything outside of one block is not possible and not profitable. A soft liquidation also help us protect from these potential exploiter that could exploit the protocol. And it also makes sure that the stablecoin minter don't lose that much money. And just like what Martin said before, right? USDT has this moat. And then even with Curve, where we think we have a very innovative design of stablecoin, it still comes down to how many people actually use CRV-USD and who wants it and how much yield can we really give out. And I can tell you, having these over collateralized stablecoins. So imagine you go to a bank and you want to borrow $100. You give the bank $300 deposit and you borrow $100. It doesn't make much sense. LRT, I think it's possible. Hence why we think these LRT-backed stablecoin has a lot of chances. And then Curve stablecoin enhance that in a way that not only you have these LRT yields, but on top of that, you can use it in the Curve ecosystem.
That was great. Thank you so much, Chris. Let's talk about Algo stablecoin.
I think the classic example that everyone would know is Terra Luna. It crashed, but before that, everyone thought it was the best thing since sliced bread because you could get high yields, right? So essentially what an algorithmic stablecoin does is that through smart contracts and some kind of algorithm, it ties the value of the stablecoin to the US dollar. The cool thing is that there's no centralized force doing this, which is also a potential for disaster. In the case of Terra Luna, the UST was pegged to the dollar. Anytime that the UST went below the value of the dollar, you could swap it for $1 worth of Luna, and then the price will start to go back up as people bought UST and vice versa. So this mechanism is very clever in maintaining the peg of UST to a dollar. However, the problem comes when obviously there's a run and people lose confidence in the Luna ecosystem, the Terra ecosystem, and that's exactly what happened. There was a death spiral, as we all know, and Luna UST went to zero. So this is obviously in hindsight a flawed design, but the beauty of it was that it was so captivating and this just gave high yields and it was automatic. At the time I seriously thought that Luna could succeed because it had an ecosystem back it up. This is a classic example of algorithmic stablecoin, very dangerous but very sexy.
No, I would say to sum up, I think when you're holding a stablecoin, you are holding claim to someone, right? So when you hold USDT, you have a $1 claim to Tether. When you hold CRV-USD, you have a $1 claim to the CRV-USD smart contract. You have to trust that the issuer of that stablecoin is going to give you your money back. Because you have to believe that the person who you're going to give that stablecoin to also believes that. You drink directly from the source. So US dollars issued by the US government, USD bills are the US government debt essentially. So you're directly at the source. And then you can get into more creative ways of actually building this, like a very good claim. The trade-off here is the creativity brings a lot of value, right? So the yield related to crypto-backed stablecoins is definitely today higher than the yield created by the US government. But there is a trade-off with how easy it is to explain to the person you're going to give that dollar to that they're going to go and be able to actually claim it back. And the more complex the design, I think it gets interesting from a study perspective, but it gets a lot harder to explain to the person you're going to give that dollar to afterwards why they should trust that claim is going to be.
Let's talk about Mountain Protocol, USDM then. USDM is a new stablecoin backed by UST bills. What is the story behind creating USDM?
My background, I've been working in traditional banks for almost 10 years, very familiar with like deposit and lending institutions. I've been in crypto. I'm from Argentina, so very similar situation. Like we have a lot of inflation. I started buying Bitcoin. That was the first thing I could buy to essentially hedge from inflation. And been in the crypto space ever since. When Luna happened and interest rates in crypto went to like down almost to zero, right? So it was essentially free to get money. I was like, okay, where should I put my money? And I started putting my money in USDT. I'm surprised at the gap, right? At the time, the USDT were paying 1.7% and Aave was 0 point something. So I was essentially looking at Aave and just putting money on T-bills myself. I was like, it's ridiculous that. Then I clicked, ridiculous that Circle is making all this money, Tether is making all this money. And then people are taking smart contract risk, putting their ETH in a smart contract. And then Circle is doing nothing and they're getting 1.7. Someone has to have solved this problem. I also had my mom asking me, okay, what should I do with my money? Because I also manage some of my money for her. I was like, there's nothing I can do for you. I was like, we should have a better way of building a very safe asset, right? Like, I don't think we need to reinvent what the safest stablecoin looks like, right? Fiat-backed stablecoins have gone on like several up and down cycles. We know they can grow. We know they can come down. But we have to create a stablecoin that is fair for the user in that it's not extracting all the value. It's actually paying most of the value to the holder in the form of rewards. So that was the insight for USDM. On the implementation side, this happened in 2022. On the implementation side, we were very much around how do we build this to be future-proof, right? Like, we know this is not going to be a degen product. Degens, they're going to go for riskier products further in the risker. This is for people who want to be conservative. How do we make sure we build Mountain Protocol with the best guarantees that you have? So we decided to go regulated. So we are one of the only regulated stablecoin issuers and the only yield-bearing stablecoin issuer. What that means when you say regulated is you're trusting us, but you're also trusting a regulator that is putting their stamp that we're doing things properly, from audits, from how we manage your processes and everything else. And then the quality of your asset is a lot better. And especially for institutionals, they really like USDM and how it's built, and it gives them a lot more comfort. It took almost 18 months to get all of that there. And we launched kind of Q4 last year, and currently sitting at around 150 million EVL, close to PayPal, which is like $1 million ahead of us. So probably we'll pass them soon.
Wow. Congratulations. You talked about the inflation in Argentina. Can you just help me visualize how bad it is?
Several things. People that have not lived in high inflation environments have a very hard time imagining what it looks like. So first thing, since 2011, which was my first salary, which went to Bitcoin, I have never seen inflation in Argentina below 40% per year. That has been the minimum. Last year, inflation there were some months of 300% annualized inflation. So anything from 40 to 300 was kind of what we've seen in the last kind of decade. What does that inflation mean is you lose context of what things are worth, right? Let's say you take a 2-month trip somewhere, you come back, and you have to think about the prices in the supermarket in US dollars, because if you think like they don't make any sense when you think about them in pesos, because in 2 months you might have had 20% inflation. So like, is this cheap or not? It's hard to get a sense. Many things change, right? So when a society starts to get used to that inflation, people that wouldn't traditionally be in crypto start being on crypto, right? My grandma, she buys USD now. She used to buy USDT. So she gets her retirement income in the first 5 days of the month, and she buys dollars and then keeps those dollars until she needs to sell to pay her credit card. She's 89 and she doesn't make that much money, but like everyone is the CFO in that country. If you have not gone to Argentina, I think it's a pretty nice place to go and actually see economics push to their limit and kind of what free markets do to actually solve these things. But the biggest thing people are searching is stability, right? And that's why stablecoins are so popular in a place like Argentina, because it's even though the US dollar has its own inflation, 5% or 7% or 8% we had last year is nothing compared to 200, right? So people mentalize 8% as similar to zero. In terms of inflation.
It's very hard for me to imagine that. I actually went to Argentina pre-COVID, and it was like the most beautiful place. We were just walking dogs, everyone's like living their life. So it's very hard to imagine all that. And the example you gave was pretty amazing. How you go on a trip and come back. Okay, if you were to create one USDM, what has to happen before that? Or what does the process look like?
Now that we have the license and all of the financial infrastructure, creating USDM is quite simple. You can send us a US dollar, like fiat, like a wire transfer or a Swift transfer, or you can send us a USDC, and we'll create your account with $1, and then you can withdraw one USDM. What's going to happen in the background is once we receive the asset, we're going to mark it as $1 in the USDM reserve database. That is going to get invested, right? Sent to an investment manager. We recently announced we're working with BlackRock's recent fund, so that's going to be essentially managed by them. And then on the asset side, we're going to mint a new USDM. So that mint process, we usually have some USDM that we hold on balance sheet, but if you're going to be doing a larger purchase, we're going to mint and we're going to send that to you. So it's a very straightforward process in which money comes in, gets sent out for investment, and then new minting happens and that gets sent back to you, right? And in the end, our job is to make sure that those checks and balances always work, so that the USDM is always backed. And when you mint or redeem, those two accounts essentially check out.
Where can we find USDM, and what are the best ways to use it, to utilize it?
So the best place to find USDM right now is DeGate. So you bridge any asset into DeGate, and you get a kind of centralized trading experience that is actually decentralized. So you own full custody. You can use USDM for trading. I think the biggest use case today for USDM in DeGate is you just use for example, ETH USDM pair, which allows you to trade. When you're in ETH, you're in ETH, but when you're in dollars, right on the other side of that trade, you're earning the reward rate of USDM, which is currently at 5%. So essentially, you kind of get the best of both worlds. You are like having your trading activity, but at the same time, sometimes you are long and you're in ETH and you earn all the ups and downs of ETH, but sometimes you're short and you're on the USD side, you're earning that 5% without having to think about that risk. And then at the end of the day or month, you just go and claim your reward in the US. Quite simple.
That is amazing. Alvin, why did DeGate decide to integrate USDM?
First of all, I think that, as you can all see, Martin is he knows the stuff super well. He's whenever I see Martin on videos, he's always to the point, crisp in his logic, and warm. So I think that the team in general is a top-notch team. I think that if you look at the background of the team, and not just the USDM team, but the team of investors like Nate Carter from Castle Island Ventures, I think it's Coinbase and a few others. So in my perspective, it was an easy decision. So one crucial point is that USDM is a quote token, which means that it can be used as a unit of account, like to like maybe ETH versus USDM, or WBTC versus USDM, or any other token versus USDM. So I think that integration is because we saw how committed and how clear thinking and long-term thinking the team was. One important philosophical point is that $1 has to be $1. So USDM, because of rebases, like the unit of account is $1. As the 5% yield is given back to you as a rebasing. So maybe in the year you have 100 USDM, you get 5 USDM more as a rebase. So philosophically, people over time will tend to see something like USDM as a unit of account as $1, and that helps them to make decisions. I think that it has been helpful to the DeGate ecosystem to have USDM in it.
On the unit of account, I think if you're going to have a stablecoin, you have to be able to pay for coffee without pulling up your calculator and CoinGecko to find the actual price of the token, right? So if I'm going to be paying for coffee with SDAI or with BTC or with whatever, right? Like whatever non-stablecoin, you have to do so many steps that in the end, that friction will make it such that you're not going to do it.
Okay, great. We talk about all the great stuff about stablecoins, but we want to touch on the risk. Earlier on, you talk about Luna UST, right? I want to ask you if you have seen any other type of algo stablecoin that are alive and doing okay, doing well. What are they doing differently than UST?
Now we kind of have Athena, which, one might argue that it's not an algo stable, or it is an algo stable that relies on a mix of collateral and some sort of mechanic, these long, short trading strategy to maintain peg is an algo stable. And I think right now the hype is around Athena, having supporter from Deribit, BitMEX, Arthur Hayes, Binance, you name it, everyone is kind of like in their round and kind of supporting that. So I think that's also an important ingredient for a successful algo stablecoin. There's the spiral. There is a potential where the asset is used as collateral to depack or go below or go undervalued due to any sort of black swan event. In this case, it's hard to do it, but I think Athena might be able to do it just because they have kind of learned from all these previous cases and kind of build these prevention mechanisms that allows it to not go into a crazy death spiral. USD is kind of an algo stable as well, right? USD is probably under collateralized, but it has a bunch of use cases, a bunch of venues, and everyone believe it, and it has the biggest, dopest army in the world, so everyone's afraid of it. So, even though it's under collateralized, it's still hacked. I think everyone is not wrong trying to recreate something like that in crypto, and whoever that can actually do it might be as successful as Bitfinex, because essentially you will not only be able to print money out from thin air, but you will also be able to convince a bunch of people to use it. And that is one of the greatest creations, if possible. How Luna works is you use Luna as collateral and you mint USD. And if UST goes below peg, then you mint more Luna and then it goes in. But then as panic hits in, people start selling UST, then you mint more Luna. I think it is possible to save it if they just decide not to mint any Luna and just be like, let it depack for a while. If we think about it, right, USDC was depacked for 2 days during the Silicon Valley Bank crisis, and actually it was depacked for a week if we think about it. And if you give it enough time and for people to calm down, then there are ways to save it. It's the same thing why the Fed raised interest rate, right? It's kind of to ensure fear, right? To tell people like you should stop spending money or you should start spending money. It's not as effective retail, but it is incredibly effective when you want to tell a story to be like, the inflation is high right now, or we are in a quantitative easing, or we're strengthening, right? So it's about that message. So I think a lot of people that are designing stablecoin have to remember how important it is to communicate to the retail and tell them, be like, I know shit has hit the fence, but you guys gotta calm down and then not to sell, right? And then try to figure stuff out. I think at that time, Luna had a chance to kind of communicate, but at the same time, they keep printing money. If they decide to stop printing Luna, wait a bit for 10 days, they might have a chance. We can play this ChatGPT and see if the scenario works out.
Yeah, because I'm like, practically, yeah, it sounds right, but could they actually do it?
Yeah, I think Do Kwon or their team has a key, right? They can sign the multi-sig to stop printing.
Yeah, definitely. Like any of these decentralized stablecoins are not as decentralized as claimed. The way I look at risk as stablecoins is very much going back into like how banks manage risk. So when you have a stablecoin, you usually have $1 backing for $1 of liability. Usually there's some form of impairment on the collateral, right? So instead of having $1 to $1, you have 98 cents to $1. You have 2 cents that are not going to be recoverable, at least for the short term. And what you end up happening is the smart people that have this dollar, they're going to claim it back to capture the 98 cents to make sure that they're not left with the loss. And that's what generates the bank run. And then the last person to go in, usually retail, will get zero. And in Luna, we saw that some of the sophisticated actors had exited and made a ton of money with Luna. And then retail ended up holding the bag. I think the issue that we see with many of the stablecoins getting created is they assume everything is going to go well. And the level of counterparty risk that gets layered on top of layers of counterparty risk on the collateral side, you need one thing to go wrong for the whole stablecoin to create a bank run. So That is the thing. I'm a big skeptic on having my grandma buy any kind of like crypto-backed stablecoins or algorithmic stablecoins, because I believe my grandma, she's going to be holding the bag, right? Like she's not sophisticated. I think that applies to many people in retail. How many layers of risk are you taking when you're buying some of these decentralized stablecoins? Probably tens of layers. You need one to go wrong. The sophisticated actor is going to get up very quickly, and then you're going to be holding the bag. And I think that's the risk that you should be looking when you're looking to buy a stablecoin or actually any type of asset. I think stablecoins, particularly given the leverage, is am I going to be the fast capital leading, or am I going to be the slow capital holding the bag? And if you're the slow capital holding the bag, you need to make sure that it's never going to explode. And the simpler the model, the less likely it is for it to actually explode. When I think about like risks for fiat-backed stablecoins, it's fairly simple. You already have T-bills. Those T-bills, could they be impaired? Potentially, yes, if the US government decides to default. Unlikely, because they can always print more, right? So they would most likely print rather than default, but potentially. But outside of that, even if the smart contract gets hacked, for example, or if there's some sort of impairment on the asset side, the T-bills still exist. You can always go back, sell them, and give people their money back. So I think fiat-backed stablecoins in general, if you trust the management and if you trust that their processes are sound, it is a fairly safe model. Once you start adding risk, so for example, a pool of stablecoins, and you're going to say, okay, I'm going to buy 4 or 5 different stablecoins to create another stablecoin on the other side, you are taking the risk of the worst of those stablecoins. Because if one collapses, let's say you have 20% each, one collapses, now you have 80 cents per dollar. People are going to leave. So very quickly, you're going to have 20 cents or 40 cents in assets. So you lost 50%. In my opinion, if you're a sophisticated actor, you should look at these risks and monitor them and make sure you leave quickly. If you're not a sophisticated actor, try not to put money you're not willing to lose into these types of strategies, because the level of risks are multiple and only one of those is going to create a loss. And if you're slow, you're going to eat all of the loss yourself.
I love that, because you know how people usually compare, oh, this stablecoin, that, which was better. But I think you broke it down really well. Like, just look at the risk, and yeah, I love that. Thank you.
My perspective as a bystander of like these evolving dynamics is I'm reminded of the quote from Shakespeare's Romeo and Juliet, where the friar says, "These violent delights have violent ends." So, what makes a stablecoin attractive sometimes is the yield for, like for Terra. And that's also part of the downfall of sometimes, because these yields, I don't see how they're sustainable sometimes. And I think we're seeing a bit of that dynamic happening again this bull run. However, how do you make a stablecoin popular? I think that one way is to have great yield, that's for sure. The other way is great marketing. And on the other end of the spectrum is trust in operations. So I think that doing the right thing to get the distribution of your stablecoin, I think that, I hate to say this, but Tron has done a good job with USDT on Tron.
If you're a company, the salaries for your employees for the next month, you're probably not going to put them on something experimental.
Yes.
If you have $100 and you just want to try something and potentially farm an airdrop or something like that, you might go further on the risk curve. As always, you have to think about like what's the type of investment that you're doing, whether it's about cash preservation or capital preservation, or whether it's I'm going to take risk on this because I think I can get a big reward. The word stablecoin usually tries to confuse the latter, the high yield, and try to mimic the risk of the former. So it's like, why would you hold X very high yield, very stablecoin and not hold USDT or USDC as if it was the same risk? And I think the key thing for people buying these assets is these are not the same asset, right? And think about separating. If there's a risk, but there's a risk reward difference in thinking.
There's another big topic in stablecoin, which is regulation. We all saw how the US government ordered Paxos to stop issuing BUSD last year in 2023. Why only BUSD? Do you see this happening to other stablecoins?
I think the BUSD one, there's a lot of things that we need to still clarify, and lots of things that happen behind the curtains that many of us don't know. I think what we do know was that Circle kind of tipped the regulators in that Binance was bridging BUSD into their chain, and that the collateral held on Ethereum was not backing one-to-one the Binance chain assets. The other thing that the NYDFS was not comfortable is they had not allowed issuance of BUSD on that chain. And that was the argument to actually shut that down. But I think it was a warning. When you deal with certain types of regulators, you need to follow their regulations. But then the bridging, I think, was potentially a gray area in terms of actually following that regulation. It is not easy to work with regulators. It's like getting married, right? So the decisions that you usually took as a single startup, you're not taking as a couple. You have the startup and you have the regulators, and you not always agree. And it's always the decisions are not as fast, and there's lots of trade-offs. But on the flip side of that, as buying an asset that is regulated, you get the advantages of knowing that two different people with different interests have looked at this and have said that whatever they're doing is okay. That stablecoins will continue to be regulated. When I'm going to use my grandma again, but when my grandma holds a stablecoin, she thinks she has a claim to $1 that very much looks like a bank deposit, right? So she thinks she has something very similar to a Bank of America deposit or her local bank deposit. She doesn't think she owns a portfolio of a long-short trade collateralized with a multi-asset. She doesn't think she owns that like a hedge fund position. So I think they're going to continue to be regulated as closer to banks or as payment companies. And as we march forward with that regulation, I think many other things will have to be stopped called stablecoins, or I don't know if they're going to use a stablecoin term or they're going to change it. But I think there's going to be a bifurcation into potentially like fiat-backed stablecoins being regulated, and then all the other assets potentially having to change names.
We look at the historical data, Bitcoin pre and post halving, the price usually drop, right? And we wait for a few months, the price goes up again. Chris, why does this happen?
I don't know, actually. I mean, I've seen it happening for so many times. And I think the idea is, the original idea, at least back in 2012, I think, was the miners want to hedge a little bit, right? Because their rewards are getting half. If you are making X amount of money per day, and you know that tomorrow, everything you make will be a quarter of that or half of that. So your idea would be to hedge it, right? Because you have electricity costs, you have rents, you have to pay for your Bitcoin farm, right? So you would sell your Bitcoin reward and then monitor a bit. And if the price goes back up, great. But if the price doesn't go back up, you still have the money that you sold pre-happening, so you have enough treasury to maintain your Bitcoin farm and to sustain until if the price go up, right? So that's the original idea why Bitcoin price always drop before happening.
I think the other part that I'm very bullish on is the simple math of what's happening with the BTC. For every Bitcoin miners produce, there's 10 Bitcoin getting purchased by institutional buyers of ETFs, right? So the mining inflation, if you will, is getting eaten up by this kind of new demand. Now that mining inflation is going to go from about 1 Bitcoin to half a Bitcoin for this like purchase amount of 10. Many of these institutions are getting started. So to me, like the part that I'm trying to figure out is where there's a price at which all of this money getting in will clear with a new supply of BTC, which is essentially miners plus people willing to sell. I think we still haven't found that either. I think there's more inflows coming from more institutions starting on the BTC ETF that have not turned it on, and the current institutions continuing to build in that portfolio allocation of Bitcoin. The last thing I'm excited is, I don't know if it's going to happen that the ETF ever gets approved, and if it does this year, I think you're going to see the dynamic of the BTC ETF, but in PowerDrive, right? Like most of the people who run nodes keep their ETH, so it's going to be a scramble to find buyers of ETH, and I think that can create a lot of interest and a lot of price appreciation on this side. If you mine Bitcoin versus securing an ETH node, right? So proof of work versus proof of stake. In proof of work, you have to do a lot of actual work, so you have to buy very expensive machines, and you have to pay for a lot of electricity. So if you look at like these miners, it's a very competitive game. They usually don't make a lot of profit, and because they need to eat, right? So it's pay this electricity bills and pay this hardware, they need to sell most of it. When you're running a ETH node, you cannot run it on your Raspberry Pi, right? It's a pretty like a retail laptop. You can run an ETH node. It doesn't consume a lot, and therefore most of what you earn you can keep. You don't have to be spending a lot. So that means if you're running a node, but most likely you're a very bull ETH person to start with. Plus you're not forced to sell because you don't have to pay for any expenses. I don't think many of those are going to be selling.
Alvin, what do you think is going to happen this bull run?
The traditional idea of 4-year cycle is an interesting dynamic between Bitcoin and ETH, right? So Bitcoin is known as, at least to us, as the digital gold. It's like the store of value. Whereas ETH is fundamentally not seen as a store of value or accepted as a store of value. So the value of ETH comes from its utility as, if you like, digital oil, like that powers the Ethereum blockchain. So as the transactions move to layer 2, like I do wonder what the price will be of Ether as a gas, in layer 1. So that might affect the long-term projections of the value, because the model is one of valuing it via the utility of the Ether rather than a digital gold. So on the one hand, I'm bullish with the Ethereum ETF hopefully upcoming, but on the other hand, it's fundamentally a different product from Bitcoin in my mind. To the point of like the bull run, it's all macro, right? If crypto is an amplifier of the macro environment, so my personal opinion, not financial advice, is that macro environment is bullish right now. It will be until the end of the year, more or less, but truth is nobody knows. So I'm bullish on crypto this year.
I love that summary. Yeah, with the Ethereum ETF though, isn't it hard to explain to, let's say, your grandma what ETH is? It's easier to explain what digital gold is.
Bitcoin doesn't have, which is native yield, right? So it is easier to sell a product where you say, you don't need to believe that ETH price is going to go up as long as you have some native yield on your ETH. And I think for TradFi people, specifically for institutions, it's very easy to understand that type of product, because you don't need to have someone else come and buy it from you at a higher price. You're just accruing more value on a daily basis, despite price being flat.
Alvin, what are some trends that you're paying attention to this bull run?
What's super interesting is the rise of RWAs and USDM, for example, as like a yield-bearing stablecoin. So it's on one side of the spectrum, and the other side obviously is meme coins. Meme coins is like, if stablecoins backed by fiat make a lot of sense, meme coins are on the other end of the spectrum. They make absolutely no sense, except like as an expression of animal spirits, right? People just want to gamble on something. Isn't that crazy that we have two ends of the spectrum in the same crypto space? DEX is like DeGate, which is an order book DEX that you can easily trade spot and do a lot of yield strategies like grid strategy. Other DEXs are interesting, like DYDS and Uniswap. So yeah, I think the DEX is going to get increasingly important.
Chris, what are some trends and narratives that you're paying attention to?
Oh man, I'm like a shotgun. I think I pay attention into everything. I mean, ever since last year, I've been investing into LRT protocol, right? So some of my earliest bet in the eigenlayer ecosystem, such as Puffer, I believe that there are multiple ways to earn yields. If we think about these light nodes, right? And we think about these validators, they can do so much more than maintaining the Ethereum network. If you think about these validators as, let's say, a tennis coach, and then they're 75% of their time have to be at the court to wait for a student to come, but they only have a few students every year. Due to the company policy, this tennis coach have to be at the tennis court 75% of the time. If he does not show up, he gets penalized and could lose his collateral that he put into the company. But the thing about it is that 25% of the time, this tennis coach could teach something else, maybe ping pong, maybe badminton, maybe basketball, right? And he can earn that extra salary by teaching something else. And that's the beauty about running these validators and how so many other protocols need it. Data availability, decentralized sequencer, Oracle, bridges, all need validator. And Ethereum has one of the most robust design. And I think another big part that I'm looking at, another huge sector that I'm betting on, the physical light node. So last year, we saw Solana Saga Phone went crazy, how they give airdrops specifically to Saga holder, right? And how do they do that? It's because each Saga has a unique code that represents it. And then you use that to generate your wallet. So you get these airdrops, right? So if you think about it, right now, 30% of ETH is at Lido, right? Lido charges 10%. We were talking about how much money Tether were making, right? They made around 1.2 billion a year from Ethereum staking, right? And then so that's why Ethereum is kind of centralized in a sense. It's even more centralized in a sense that most of these validator runs on GCP or AWS. So I think another sector that I'm very bullish on is how do you economically scale these live node that you can go to an Apple store and buy it, like spend $500, buy the node, put it in the SIM card, and start running it.
Wow, what an amazing conversation, guys. Thank you so much.
谢谢你看到这里哦，欢迎用下面的连结到 Line 跟 Discord 群组，跟努力的大家一起讨论。我们在 OKX、币安、派网呢，跟其他的大交易所都帮大家争取到了最高8折 20% off 的交易手续费减免。用下面的连结注册呢，你的交易成本就更低了。也欢迎告诉我你接下来想要看什么，我们在币圈继续努力，下一次见，拜拜。